What if I told you there's a company with a revolutionary vision for the future of AI and Web 3.0, partnerships including the likes of IBM, and Analyst targets that suggest an upside of over 400%? It sounds like the investment of a lifetime. But what if I told you that same company is facing a critical liquidity crisis, holds just over $1.5 million in cash against nearly $29 million in debt, and has an official going concern warning in its SEC filings? This is the story of Datavault AI, ticker symbol DVLT. It is a high-stakes gamble that could either lead to explosive returns or complete insolvency. Today, we are doing a deep dive into the data, cutting through the hype to find the truth. Is this the next big thing in tech, or is it a financial disaster waiting to happen? Let's break it down. First, who is Datavault AI? You might not have heard of them, but you may have known them by their former name, YSA Technologies. Originally a company focused on acoustic science and spatial audio, they have undergone a massive corporate reinvention. In February 2025, they rebranded to Datavault AI, making a strategic and ambitious pivot into the world of data science. Their new focus is on some of the hottest sectors in technology: in information data exchange, Web 3.0 integration, tokenization, and edge computing. This isn't just a small shift, it is a complete reimagining of the company's future, aiming to capitalize on the massive AI and Web 3 narrative. Their ambition is staggering. Management's plan involves a nationwide rollout of a private edge cloud network to over 100 cities, with a target start date in the second half of 2026. The revenue goals are equally bold. They are targeting $200 million in the near term by 2026 and a jaw-dropping $2 to $3 billion by 2027. They project the potential for over $2 billion in annual recurring revenue per major metro area. To add a layer of credibility to this vision, Datavault has secured some very impressive partnerships. They are expanding a collaboration with IBM to deploy Watson X AI, bringing enterprise-grade artificial intelligence to local infrastructure. They are also working with FinTech TV to pilot a patented bias meter, which uses AI to detect skewed media reporting. These aren't small names. Having third-party validation from enterprise leaders like IBM is significant and suggests the underlying technology has real potential. This powerful narrative has caught the attention of market analysts. Maxim Group has a buy rating with a $4 price target. Ascendiant Capital is even more bullish, also with a buy rating and a stunning $11 price target. From the stock's current level of around 74 cents, this consensus implies a potential upside of over 400%. A key part of their strategy is capitalizing on the tokenization of real-world assets. They are specifically targeting the tokenization of name, image, and likeness rights and sports autographs. It is a modern, forward-thinking strategy that taps directly into the creator economy and the booming market for digital collectibles. So, to summarize the bull case, you have a revolutionary product suite, a massive total addressable market with potential for billions in revenue, and validation from a giant like IBM. It paints a very rosy picture. But a picture is not the same as reality. Now, let's pull back the curtain and look at the numbers. This is where the story takes a dramatic turn. Remember that $3 billion revenue target for 2027? Well, the company's actual revenue over the last 12 months is just $6 million. This isn't just a gap, it is a chasm. The entire valuation of the company rests not on what it has done, but on perfect future execution of a plan that hasn't even started yet. But the bigger, more immediate problem is solvency. The balance sheet is flashing major warning signs. The company has only $1.68 million in cash on hand. To put that in perspective, their total debt is nearly $29 million. This has triggered an official going concern disclosure in their SEC filings, which is an accounting term that means the company may not have enough money to stay afloat. They need immediate financing just to maintain current operations, let alone fund a massive nationwide expansion. Their operational burn rate is staggering. They posted a net loss of over $94 million over the last 12 months and a negative free cash flow of $28 million. They are burning through cash at an alarming rate. If the financials weren't concerning enough, The actions of leadership and the market's reaction raise even more red flags. Over the last 6 months, there have been 0 insider purchases of the stock. In that same period, there have been 20 sales. Key sellers include major stakeholders and even the CEO, who have offloaded millions of shares. The insight here is brutal. While leadership is promoting a billion-dollar future to investors, their own actions suggest a lack of confidence. The market seems to agree. There is a consistent sell the news pattern. On January 8th, when the IBM news broke, the stock dropped over 12%. On January 12th, after an investor conference discussing the 100-city rollout, it dropped another 3.5%. And on January 14th, with news of the bias meter, it fell over 10%. Positive PR events are being used by the market as opportunities to get out. Then there are the credibility concerns. The company announced a dividend distribution for February 2026, not in cash, but in Dream Bowl meme coin 2 tokens and stock warrants. The fine print is what is truly concerning. The company explicitly states these digital collectibles may have no actual value. This is a tactic more characteristic of high-volatility meme stocks, not a serious, institutional-grade infrastructure company. So what are we left with? On one hand, you have the bull drivers, a revolutionary vision, a massive market, and IBM validation. On the other, the bear drivers, imminent risk of dilution to raise cash, a going concern insolvency risk, heavy insider selling, and a broken technical chart. The final verdict is clear. DVLT is a lotto ticket play. The upside is theoretically huge, but the immediate risk of further dilution or even insolvency is the dominant factor. You are not betting on a proven business model. You are betting on a company's ability to navigate a severe liquidity crisis while trying to execute an incredibly ambitious plan. For anyone considering this stock, a buy and hold strategy is extremely risky. The analysis suggests waiting for the company to narrow its losses or secure significant non-dilutive financing. Key technical levels to watch are the $1.02 resistance and the 66-cent support. A break below that support could see the stock fall to its 52-week low of 25 cents. Datavault AI presents one of the most fascinating high-risk, high-reward scenarios on the market today. The vision is compelling, but the financial reality is dire. This is a wager on execution against very, very long odds. What are your thoughts? Is this a once-in-a-generation opportunity or a trap for retail investors? Let me know in the comments.
All right, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.